Welcome back to the Deep Dive, where we decode the architectures of wealth. Today, we're really tearing into some fascinating source material. It outlines these often hidden, pretty sophisticated rules that the ultra-wealthy use to, well, minimize their tax obligations legally.
Yeah, think of today as an advanced course. We're looking at, I believe, 15 distinct methods, and these are institutionally recognized. Crucially, like you said, they are entirely legal methods. They're employed by the most expensive tax experts out there.
Exactly. And our goal really is to move past the headlines, the kind of superficial stuff, and understand the mechanics, the how and the why behind this sort of high net worth tax planning.
And we should probably start where all great financial complexity seems to begin. It's this core premise that the wealthy kind of rely on, right, to justify hiring these expensive experts.
Right. And it comes from one of history's greatest minds, actually, Albert Einstein. He summed it up perfectly. He said, the hardest thing in the world to understand is the income tax.
And that confusion, that complexity, it's like a maze, really. That's precisely where the opportunity lies, but only for those with the resources to hire the guides, the experts who know the way through.
So our mission today is, well, pure knowledge acquisition. We want you, the listener, to understand the rules of the game. Then you can assess, whether any of this is relevant to your own financial life now or maybe later.
Definitely. And before we jump into the nuts and bolts, corporations, trusts, art foundations, all that, we absolutely have to stress the mandatory caveat.
Yes, super important. These strategies we're discussing today, they involve immense complexity. They often require substantial upfront capital, significant operational costs. They definitely increase the risk of audits.
And the laws are always changing. Always.
No doubt.
So we're reporting on observed strategies, things that have been used historically. This is purely educational.
Absolutely. Not financial advice, not legal advice, certainly not tax advice. Always, always consult a qualified professional before you even think about applying any financial concept like the ones we're discussing.
Okay. With that very important groundwork laid, let's dive straight in. The first and arguably most powerful tool the wealthy use is optimizing the business and investment architecture itself.
Okay, let's unpack this. We can start with what I think of as the first major principle, maybe the golden rule. Reinvestment is not taxed. Sounds simple, almost too simple, but the implications are just staggering.
It really is the foundation of how high net worth individuals grow their wealth. The source material is crystal clear on this. The wealthy just don't let retained earnings sit around as taxable cash in the bank. It doesn't make sense.
Right.
They continuously use the rule that says money actively plowed back into economic activity. Capital expenditures, growth initiatives, R&D, that money is excluded from taxation in the current period.
Okay, let's make that concrete. Let's use the example from the sources. Say a company is looking at netting maybe $5 million in profit this year. If they just let that cash sit there, boom. Massive tax bill, either corporate or pass-through, depending on the structure.
Right. But instead, the owner, working with their accountant, looks ahead. They decide, okay, let's accelerate some capital spending before the year ends.
So maybe they buy, I don't know, $5 million worth of new machinery, cutting-edge stuff, or they lease a second factory space or launch a huge digital ad campaign for the next quarter. They do it before the fiscal year closes.
Exactly. And by doing that, they turn that potential profit into a current year necessary business expense. The result, zero tax liability on that $5 million.
It's such a powerful lever.
Yeah.
It's not just that they avoided paying tax on the income right then. They've also accelerated their company's growth. They're using money the government would have taxed to buy an asset or fund something that will generate more wealth down the line. Their net worth just grows exponentially faster because every dollar is working, not sitting idle waiting for the tax collector.
And that's the crucial distinction, isn't it, between tax avoidance, which is proactive, planning, and legal, and tax evasion, which is hiding income, which is illegal. This is all about using the existing rules.
Right. And that leads perfectly into the second golden rule you mentioned. Deduct everything.
Well, everything that's legally deductible, of course. The core idea is if an expenditure can be convincingly proven legally as necessary for the business to function, it shifts from being a personal expense paid with your after-tax dollars to a business expense paid with pre-tax revenue. Big difference.
And we're not just talking about paper clips and staples here, are we? The ability to, let's say, aggressively categorize expenses within the legal bounds. That's where the complexity and the advantage really comes in.
Oh, absolutely. The list of deductible items mentioned in our sources is vast. Think sophisticated technology, laptops, high-end smartphones, specialized software, necessary gadgets, all potentially business expenses.
And it keeps going, right? What?
Travel expenses. Now, this gets scrutinized, but first-class flights, five-star hotels, if they are genuinely integral to closing a deal or meeting a key client, home office costs too. But these have strict rules, needs to be a clearly segregated space, used exclusively for business. If you meet that, you can deduct a portion of utilities, internet, maybe even rent or mortgage interest.
Health insurance premiums, too, for employees, including the owner.
Yes, generally deductible business costs. Even dining out, if you properly document it as a legitimate business discussion, it's often partially or even fully deductible, depending on the current rules.
But the strategy that always seems to blow people's minds is the car strategy.
Ah, yes. This one really highlights the pre-tax versus post-tax difference. Instead of you, personally, buying a high-end vehicle with money you've already paid income tax on.
Right, out of your salary.
The company purchases or leases the car. Why? Because it's argued as an essential piece of equipment for conducting business, visiting job sites, meeting clients, that sort of thing.
And there's a kicker, too, isn't there? Something about vehicle weight.
Exactly. Our sources point out that many high-end vehicles, especially larger SUVs and trucks, weigh over 6,000 pounds. This specific weight class makes them eligible for some very favorable accelerated depreciation rules, particularly under Section 179 of the IRS tax code. Meaning the company can often write off a huge percentage, sometimes even the entire purchase price, in the first year they put the vehicle in service. This massively boosts that paper loss strategy we'll touch on more later.
Wow. So the company gets a big write-off, and the owner gets the use of a luxury vehicle, essentially paid for with untaxed business revenue.
That's the essence of it. Paying with pre-tax revenue versus post-tax income, it's the core game changer. And it extends very powerfully into how executives and founders actually choose to get paid.
Ah, right. That brings us to the compensation shift. Taking equity over salary. Why would a super successful CEO, like some examples in the sources, take basically a zero cash salary or maybe just $1? It seems counterintuitive.
It's definitely a long-term play. It's all about tax efficiency. There are really two core benefits driving this.
Okay, what's the first one?
First, equity, whether it's stock options, restricted stock units, RSUs, performance shares, whatever form it takes, it has the potential for exponential growth. $1 of salary today is always just $1. And it's taxed immediately, usually at the highest ordinary income rates.
Whereas $1's worth of equity
could become $50 or $100 down the road. And crucially, that gain is deferred. It's not taxed yet.
And that deferral, that's the second big point, isn't it?
It's arguably the most powerful point. Your W-2 salary. Taxable the moment you receive it, period. Equity, on the other hand, generally isn't taxable until you actually sell it, or sometimes until a vesting period ends, depending on the structure.
So they can put off paying taxes for years, maybe even decades.
Potentially, yes. And when they do sell, they can often structure it to benefit from long-term capital gains tax rates, which, provided they've held the asset for more than a year, are significantly lower than those high ordinary income tax rates.
So their wealth isn't sitting in cash. It's held in these non-cash asset stocks, maybe real estate, complex debt instruments, assets that are hopefully appreciating and, crucially, offering tax deferral.
Exactly. They avoid the immediate high tax hit that comes with cash income. It keeps their wealth growing, untaxed, until the absolute last moment they need to actually realize a gain. Well, it's probably the smartest approach to high net worth cash management. Okay, so once that internal architecture of the business is optimized, reinvestment, deductions, compensation, the wealthy then look outward.
Right. The next layer is leveraging geography, basically. Where you reside, or maybe where your intellectual property reside, can dramatically change your effective tax rate from, say, 37% potentially down to 0.
The most direct strategy here, and maybe the most difficult logistically, is simply moving to zero income tax jurisdictions.
We're talking about places like Dubai, Monaco, the Cayman Islands, the Bahamas, those kinds of places.
Precisely. If you successfully establish your primary residence, your domicile, there, you can legally remove yourself from the income tax structures of your previous high-tax home country.
But that sounds complicated.
Yeah.
Especially for, say, Americans. The IRS doesn't just let you walk away, right?
Oh, absolutely not. It requires extreme dedication and careful planning. For U.S. citizens, you generally have to pass complex tests, like the substantial presence test, proving you spend very limited time in the U.S., often less than 35 days a year.
Wow, that's not much.
No. Or you might qualify for the foreign earned income exclusion, but that has its own limits and rules. Crucially, you have to prove a genuine domicile abroad. That means really severing significant personal, social, financial ties with your former home. It's a high bar.
And the sources mentioned this creates a kind of unfair advantage, or at least a huge barrier to entry.
It really does. Think about the cost of living in Monaco, for example. It's astronomical. You have to not only move there, but maintain a genuinely lavish, high-cost lifestyle to convincingly prove residency.
Which most people obviously can't afford.
Right. But for the super rich, if they're saving, say, tens of millions in taxes each year, the high cost of living in Monaco is easily justified. It becomes an exclusive, high-cost club, but the membership fee, effectively, translates directly into massive long-term tax savings.
Okay, so that's moving yourself. What about moving parts of the business?
Yeah.
Like the intellectual property?
Ah, yes. Now we move from individual residency to corporate structures. This brings us to a strategy that really defined modern corporate tax planning for decades: overseas IP and licensing schemes.
This is the one you hear about with the big tech companies, right? The Apples, Googles, maybe pharmaceutical companies like Pfizer.
Exactly. Those are the classic examples. It's a truly brilliant, if complex, flow of money engineered for tax efficiency. The whole architecture is built around intellectual property, the algorithms, the patents, the brand names. These are often the most valuable and also the most easily movable assets a modern company owns.
So how does it work? How do they move it?
Well, the basic mechanism involves setting up subsidiary company in a low-tax jurisdiction. Ireland was famously used for this for a long time. This Irish subsidiary legally purchases or is assigned ownership of the company's core IP, the secret sauce, basically.
Okay.
Now, the main operating company, say, back in the U.S., technically needs permission to use its own brand name or its own technology because the Irish subsidiary now owns it.
That seems weird, paying to use your own stuff.
It does, but it's legal structuring. To get that permission, the U.S. company pays a substantial licensing fee or royalty payment every year to the overseas subsidiary in Ireland.
And that payment is deductible in the U.S.
Precisely. Because it's categorized as a cost of doing business, paying for the license, it legally transfers vast amounts of revenue out of the high-tax U.S. jurisdiction. The money lands in the low-tax jurisdiction, Ireland in this example, and gets taxed at a much, much lower rate.
And historically, this really slashed their tax rates.
Right. Dramatically. Structures like the double Irish or the Dutch sandwich, which involved multiple subsidiaries, allowed effective tax rates on billions in profit to plummet sometimes to 1% or even less.
Wow. Have things changed now? Are those loopholes closed?
Laws have definitely tightened up globally, yes. Those specific structures are largely gone, but the core strategy often remains viable in different forms. Find ways to minimize taxable income in high-tax countries by maximizing legally deductible intercompany payments to subsidiaries located in more favorable tax havens.
It's complex. And it leads to that provocative thought mentioned in the sources.
Ah, yes. The idea that some companies start to view paying full taxes not as a civic duty, but almost as a penalty for not being clever enough.
Right. The source suggested they might prefer to pay a fine for pushing the envelope with an aggressive structure rather than pay full taxes, viewing a fine as a tax for doing something wrong, while seeing mandatory high taxes as a fine for doing something right. That's quite a mindset.
It is. And that kind of resentment, whether justified or not, fuels the drive towards even more complex strategies. Which brings us to the next level, jurisdictional ambiguity, or what some call the off-grid approach.
Off-grid, what does that entail?
This is the realm of the so-called perpetual traveler, or PT. It's an individual who intentionally cultivates a lack of a single fixed residence. They might acquire multiple nationalities, multiple passports, and they meticulously ensure they spend less than the required number of days in any single country to trigger tax residency there. No single place can claim them as a primary tax resident.
That sounds incredibly difficult to manage. How do they prove where they live, if asked?
Well, that's the challenge for the tracking institutions like the IRS or other tax authorities. When asked for proof of residence, these individuals might provide documentation from various properties they own or rent globally, maybe a house they use sometimes in Thailand, a condo in Bhutan, wherever.
So they create intentional friction.
Exactly. This deliberate lack of a single, easily traceable domicile creates bureaucratic headaches. It makes aggressive tax planning easier because authorities have to chase complicated paper trails across multiple languages, legal systems. It's tough.
And this need for a non-fixed or at least a highly mobile residence connects to another strategy mentioned, something about yachts.
Ah, yes. The ultimate piece of mobile real estate, according to the sources, the yacht as a primary home, or sometimes a second home.
Okay, that sounds almost like a caricature, but is there a real tax angle?
There can be, yes. It sounds quirky, but it's actually a sophisticated piece of asset optimization. The U.S. tax code, for example, offers certain deductions and benefits for homeowners. Mortgage interest deduction is the big one.
And a yacht can qualify as a home.
Under certain conditions, yes. To qualify as a second home, a vessel or even a high-end motorhome, in theory, must meet specific criteria. Generally, it needs to provide sleeping, cooking, and toilet facilities, your basic living requirements.
So if your multi-million-dollar mega yacht has a galley, beds, and bathrooms,
Then you might be able to register it as a secondary residence. If you do, the owner could potentially qualify for tax benefits associated with property ownership, like deducting the interest paid on the loan, the mortgage used to acquire the vessel.
and on a multi-million-dollar yacht, that mortgage interest could be huge.
Enormous. So again, it's about turning what looks like a pure luxury expense into something that's at least partially a tax-advantaged financial asset. It's squeezing every possible legal benefit out of an otherwise taxable expenditure.
Okay, so we've covered business structure and location. Let's move from floating assets to other tangible investments that offer unique tax advantages. And we have to talk about a favorite of high net worth investors, apparently, the art trade loophole.
Yes, this is a truly fascinating area, partly because, as the sources note, art is often called the last major unregulated market. That lack of regulation creates opportunities.
So how does this loophole, and we should stress, the sources describe legal maneuvers, how does it work? It seems like there are phases.
There are typically three distinct phases described. It's all centered on converting highly taxed cash income into a non-taxable, hopefully appreciating asset, and then leveraging that asset for massive deductions later.
Okay, walk us through phase one.
Phase one is the expense offset. This happens when the wealthy investor uses current taxable income to buy an expensive piece of art. Let's say they have $10 million in taxable income this year if they buy a $10 million painting.
Okay.
That purchase can often be structured, perhaps through a business that deals in art or uses art, to count as an expense or a direct investment. Effectively, it can zero out or drastically reduce their taxable income for that year. They've shifted cash that would have been taxed at high ordinary rates into an appreciating non-taxable asset.
Got it. So tax avoided upfront. What's phase two?
Phase two requires some patience. Usually the sources suggest waiting about 3 years. During this time, the art hopefully appreciates significantly in value. Let's say that $10 million painting gets appraised now at $25 million.
A nice gain.
A very nice paper game. Now, deduction harvesting begins. Instead of selling the painting and paying capital gains tax on that $15 million profit,
What do?
they donate the painting at its current appraised value of $25 million. This donation might go to a public museum, or, very commonly, it goes to the individual's own private art foundation they've set up.
And donating it gives them a deduction.
A massive one. By donating the $25 million piece, they score a $25 million tax deduction. Now, let's say they're still earning $5 million in taxable income each year. They can use that $25 million deduction to zero out their income tax liability for the next 5 years.
Wow. So the initial income tax was avoided through the purchase?
Yeah.
And future income tax is avoided through the donation.
Exactly. But what if they don't want to donate? What if they want to sell eventually? That brings us to phase three.
Right, the exit strategy. Selling that $25 million painting would normally mean a big capital gains tax bill on the $15 million profit.
Normally, yes, but the wealthy utilize a specific provision in the tax code. Historically, it was best known as a 1031 exchange, or a like-kind exchange. While the rules for art have changed and are more restrictive now than for real estate, similar principles can sometimes apply, or other complex strategies are used.
So what's the principle?
The core idea, the goal, is to allow the investor to sell that appreciated asset, the $25 million painting, and immediately reinvest the entire proceeds into buying another, perhaps more valuable piece of art, or maybe a collection of art. If structured correctly, often through qualified intermediaries, they can legally defer paying capital gains tax on that $15 million profit.
Defer indefinitely.
Potentially. They can keep swapping art for art, growing their collection, building value, and never trigger a taxable event until they finally decide to cash out completely, or perhaps until the asset passes through their estate where it might get a step up in basis.
That is a truly sophisticated financial architecture built around a unique asset class.
It absolutely is. Now, a similar concept, but one used much more frequently and with broader application, involves using depreciating assets on paper. This is huge in real estate and manufacturing.
Depreciation.
Right.
That's not actual cash going out the door, is it?
Correct. It's an accounting deduction. It's mandated by the government, essentially acknowledging that long-term assets, things like machinery, buildings, vehicles, wear out over time and will eventually need to be replaced. The depreciation deduction allows the business to effectively retain cash, tax-free, to fund that eventual replacement.
Okay. The source used a factory example.
Yes, let's use that. Say a business buys a factory for $10 million, and let's assume, for accounting purposes, it's expected to have a useful life of 10 years. Standard accounting might require a $1 million depreciation write-off each year. 10M, 10 years.
But the wealthy don't just do standard, do they?
Not if they can help it. They don't typically use that slow, straight-line depreciation if faster methods are available. They utilize accelerated depreciation methods.
Accelerated depreciation, like what?
Probably. This is where specific tax code sections like Section 179 and bonus depreciation become incredibly powerful. These rules, often put in place by the government as incentives for businesses to invest, allow companies to write off a much larger percentage, sometimes even 100%, of the cost of certain assets in the very first year they are placed in service.
100% in the first year?
Yes. Under current bonus depreciation rules for qualified assets, that's often possible. So let's go back to that $10 million factory. If that investment qualifies for 100% bonus depreciation.
You take a $10 million deduction in year one.
Exactly. You take a $10 million paper loss in year one. Now, let's say the business that owns the factory actually makes $5 million in real cash income from sales that year.
Okay, positive cash flow.
Very positive. But on paper, you apply that $10 million depreciation loss against the $5 million cash income. The result is a net loss of $5 million on paper for tax purposes.
So even though the business is making money hand over fist in the real world,
on paper, for tax calculations, it shows a loss. You have no profit left to tax. You've created these paper losses that perfectly offset your real taxable income, slashing or even eliminating your tax bill for the current year.
And that's how some incredibly profitable companies or individuals can report zero taxable income sometimes.
That is a major mechanism behind it, yes. Sophisticated use of depreciation is absolutely key. All right, so far we've really focused on optimizing things while you're actively earning and managing assets. The next big challenge for the wealthy is twofold. Liquidity, getting cash when you need it without triggering taxes, and generational transfer, moving wealth down the line efficiently.
Let's start with the transfer part. The simplest tool mentioned is gifting strategies.
Yes, this is really foundational planning. It's about moving wealth to heirs during your lifetime to minimize the potential hit from estate taxes later on.
How does that work? There's an annual limit, right?
Right. Correct. Every year, the tax code allows an annual gift tax exclusion. This amount is adjusted for inflation. Currently, it's around $17,000 per recipient per giver. So if you and your spouse each give that amount to, say, 4 children.
That's $17K times 2 people times 4 kids. $136,000.
Exactly. $136,000 moved out of your taxable estate, completely tax-free every single year. And you don't even need to report those gifts on a gift tax return because they're under the annual exclusion.
Okay, so that chips away at it. But the real wealth transfer happens with bigger sums, right?
Yes. While the annual exclusion is great for consistent smaller transfers, the real power for massive wealth transfer lies in the much larger lifetime gift and estate tax exemption. In the U.S., this threshold is currently very high, allowing an individual to transfer tens of millions of dollars over their lifetime or at death without triggering federal gift or estate tax.
So the wealthy use both, small annual gifts and big lifetime transfers.
Often, yes. They use the annual exclusion systematically. And for larger transfers during life, they might use sophisticated trust, things sometimes called crummy trusts, or grantor retained annuity trusts, GRATs, designed to efficiently transfer assets that are expected to appreciate significantly. The goal is to move not just the current value, but also all the future growth of those assets out of their estate entirely. It's a long game, strategic gifting over decades.
Okay, that covers moving wealth out. But what about getting cash in when you need it? If you structured all your wealth to be tied up in non-cash assets like stocks or real estate to avoid taxes, How do you pay for things? Selling triggers tax.
Ah, exactly. This is where the strategy of borrowing against assets comes in. It's absolutely critical. And it explains that common observation. Many very rich people are technically cash poor, but asset wealthy.
Why? Why be cash poor?
Because they deliberately avoid the tax realization event that selling an appreciated asset creates. Their wealth is locked up intentionally in appreciating stocks, maybe equity in private businesses they own, prime real estate, assets generating paper wealth, but not taxable income until liquidated.
So when they need a big chunk of cash, maybe to buy a new mansion, fund a lavish lifestyle, invest in a new venture, what do they do instead of selling?
They walk into a bank, often a private bank that caters to high net worth individuals, and they secure a loan, usually a non-recourse loan, and the collateral for that loan, their massive portfolio of assets. They might show the bank $500 million in stocks and ask for a $50 million line of credit.
And the bank is happy to do that.
Thrilled. It's extremely low risk for the bank. The loan is heavily secured by highly liquid assets worth far, far more than the loan amount. And for the wealthy individual, here's the magic. The cash they receive is a loan, not income. Therefore, it's completely non-taxable.
No income tax triggered. Wow. Any other benefits?
Yes. Often, the interest they pay on that loan can be structured to be tax deductible, especially if the loan proceeds are used for investment purposes. So they might actually reduce their overall taxable income further by taking out the loan.
That's incredible. It's like the perfect system for them. Instant liquidity when needed, no income tax event triggered by selling assets, and potentially even a tax deduction for the interest paid.
It allows them to maintain a very high cash lifestyle, funding whatever they need, without ever having to sell the goose that lays the golden eggs their appreciating asset base.
Okay, this ties into protecting those assets long-term too, right? Especially for the next generation. Which brings us to the ultimate tool mentioned, trusts and estate tax avoidance.
Exactly. The major threat looming over any large accumulation of wealth, particularly in the U.S., is the federal estate tax. It can be levied at very high rates historically, up to 40% or 45% on wealth exceeding that lifetime exemption threshold we talked about. It's the government's final potential bite at the apple.
So how do trusts help avoid that?
The trust solution acts like a legal firewall. When assets are placed into certain types of irrevocable trusts, they legally cease to belong to the individual who created the trust, the grantor. Therefore, when the grantor dies, those assets are outside of their taxable estate. They are simply not counted for estate tax purposes.
So the assets are sheltered from that final tax hit.
Correct. They have successfully moved the assets beyond the reach of the estate tax collector. What's remarkable, though, is the level of control the grantor can sometimes still indirectly maintain or influence while they're alive, depending on how the trust is structured.
And trusts aren't just about tax, right? The sources mentioned protection.
Absolutely critical. Beyond tax avoidance, trusts are vital for asset protection. They can shield the assets placed within them from future creditors, potential lawsuits, or even messy divorce settlements involving the beneficiaries down the line.
And the sources highlighted something about smart contract-like rules. What's that about?
That refers to the detailed instructions you can build into the trust document itself, dictating exactly how and when the beneficiaries can access the wealth. For example, an heir might only get access to 10% of their share upon turning 25, another chunk upon graduating college, maybe full access only at age 40.
Preventing the stereotypical scenario of heirs just blowing through the inheritance immediately.
Precisely. It provides control from beyond the grave, essentially, codified into a legally binding document. It ensures the wealth is managed according to the grantor's wishes.
Okay, one last strategy in this section, strategic bankruptcy and loss carryforwards. This sounds intense.
It is, and it really highlights the separation between the financially sophisticated and the merely successful. This strategy hinges entirely on the legal separation between personal assets and business liabilities, achieved through proper corporate structuring using limited liability companies, LLCs, or corporations.
The source had an example, right? A lawyer.
Yes. Imagine a successful lawyer. They own a nice $1 million house personally and earn a good $250,000 salary. Separately, through an LLC they set up, they invest in a $10 million office building.
Okay, personal assets safe, business investments separate.
Exactly. Now imagine the real estate market collapses, and that $10 million building is suddenly only worth $5 million. The loan might be underwater. The lawyer can potentially allow the company, the LLC that owns the building, to fail or enter bankruptcy protection.
And because the liability was held correctly within the company.
Bankruptcy laws generally prevent the bank or other creditors from coming after the lawyer's personal assets, their house, their personal savings, garnishing their salary. This is that crucial legal distinction the sources mention between being broke, having a negative net worth in a business venture, and being truly poor, having no personal assets. The rich can often survive being technically broke in one venture.
But is there a tax benefit here too? Or just asset protection?
Oh, there's a huge potential tax benefit. That $5 million difference, the loss incurred when the building's value dropped from 10 to 1 to $5, that financial loss doesn't just vanish. It's recorded as a financial loss for the business entity, often categorized as a net operating loss, or NOL.
And what can they do with that NOL?
Here's the key. Tax rules often allow the owner, the lawyer in this case, to carry forward that $5 million loss. They can use it to offset their future personal income, like that $250K salary.
So they might not pay any income tax for years.
Exactly. They could potentially pay zero income tax on their significant salary for many, many years until that entire $5 million loss is fully used up, offsetting future income dollar for dollar. It transforms what looks like a catastrophic business failure into a massive long-term personal tax shield.
Okay, we've covered a lot of ground: business structure, geography, assets transfers. But the world of tax optimization isn't static, right? It evolves, especially with technology.
Absolutely. It's constantly shifting. Which brings us to the strategies defining the cutting edge, starting with crypto and privacy coins.
Crypto. Right. What's the specific advantage here for the wealthy, according to the sources?
Well, beyond just the investment potential, cryptocurrencies offer a undeniable technological advantage that was immediately attractive. It's the ability, as the sources vividly put it, to transfer vast amounts of value, potentially $1 billion, on a stick, like a hardware wallet, anywhere in the world, almost instantly, and with minimal traditional oversight.
Okay, so portability and speed. How about the tax side? Are crypto gains taxed?
Generally, yes. For the main regulated cryptocurrencies like Bitcoin or Ethereum, when you sell them for a profit, that profit is typically treated as a capital gain. In many jurisdictions, if held long-term, these gains might be taxed at preferential rates. The sources mention around 10% in some places, though it varies widely. That's already quite efficient compared to, say, ordinary income tax.
But there's another layer: privacy coins.
Yes. This is where it gets into more of a gray area, the real frontier. Privacy coins, things like Monero, Zcash, are specifically designed with enhanced privacy features built into their blockchain. Their goal is to obfuscate transaction details, who sent what to whom.
Making transactions anonymous.
Effectively, yes. Or at least highly resistant to the kind of blockchain analysis that can often trace Bitcoin or Ethereum transactions. This allows for the exchange, storage, and transfer of wealth with a very high degree of anonymity.
Is that legal?
Well, owning or using privacy coins isn't inherently illegal in most places. However, the legality of using them specifically to hide income or evade taxes is obviously highly questionable and depends heavily on the specific jurisdiction and enforcement actions. It's a constantly evolving legal landscape.
What motivates someone to use them then, beyond potential tax dodging?
The sources suggest there's often a strong philosophical belief driving it, a belief that once wealth has been legally earned and taxed initially, the individual should have the right to store and transact that wealth privately without constant external governmental surveillance or potential future seizure.
That philosophy seems to tie into another point raised in the material.
Yeah.
This underlying resentment about how tax money is used.
Exactly. It connects directly to what the sources called the philosophy of government waste. The material acknowledges this widespread sentiment, maybe not just among the wealthy, but broadly, that while most people are willing to pay their fair share in taxes,
the breaking point is seeing that money wasted.
Precisely. It's the perceived inefficiency, the corruption, the bureaucratic bloat, the money spent on seemingly pointless things like pushing papers, as one source put it, the feeling that the system isn't delivering value for the taxes paid.
And the sources contrasted this in Switzerland.
Yes, as an example of a different model. The point made was that in places like Switzerland, citizens are reportedly more fine with a high level of taxes. Why? Because the benefits are tangible and visible. High-quality free education, state-of-the-art public hospitals, clean infrastructure, a sense of efficient government management.
So the perception is, if the money is used effectively and transparently, the desire to aggressively minimize taxes decreases.
Conversely, the feeling is when your money seems to disappear into inefficient or corrupt systems, it kind of breaks your spirit, as the source said. It can feel like the system is rigged against you. And that perception, whether fully accurate or not, helps validate, in the eyes of those using these strategies, the aggressive use of every legal tool available to minimize their contribution to that system.
Which leads us finally to the really future-looking idea: potential disruption from blockchain and smart contracts.
Yes, this was presented as a provocative, forward-looking thought. The belief, articulated in the source material, is that this kind of transparent, decentralized technology blockchain could massively disrupt not just finance, but how taxes themselves are collected and utilized.
Disrupts how? By bypassing politicians and bureaucrats.
Essentially, yes. By bypassing much of the traditional political and bureaucratic middle management layer where waste and inefficiency are perceived to occur. The proposed solution sounds radical, almost like a form of direct democracy for tax spending.
Like an app.
Sort of. Imagine an application where citizens could directly choose, or at least strongly influence, how their individual tax contributions are deployed. You could allocate percentages. I want X% to go to fixing roads in my town, Y% to fund the local school, Z% to support that public hospital initiative.
With full transparency on where it actually goes.
That's the key, radical transparency. The idea is this choice, combined with real-time blockchain-verified tracking of how the funds are spent, minimizes the opportunities for corruption and waste. Maybe a small slice automatically goes to essential national functions like defense, but the bulk could be user-allocated.
That feels revolutionary.
Yeah.
And potentially chaotic.
It's definitely out there. But the sources suggest this model leveraging automation, transparency, and user choice via smart contracts could fundamentally reshape our relationship with taxes, maybe even within this decade. It's a fascinating possibility. #tagged outro. So what we've really decoded today is, well, a comprehensive playbook, the one used by the ultra-wealthy and their advisors. We've run through, 15 complex strategies, everything from optimizing corporate reinvestment, using things like accelerated depreciation.
Right, Section 179, bonus depreciation.
Exactly. To leveraging international jurisdictions, using unique assets like art through, like kind exchanges or foundations, and ensuring wealth passes efficiently through generations using sophisticated trust and strategically carrying forward losses. It's a lot.
It really is. And the core lesson here, I think, for you, the listener, is that just knowing these specialized rules exist is valuable, even if most of these strategies aren't immediately applicable to you right now. Understand the complexity of the tax code, how it's navigated by experts. That's powerful knowledge.
And remember, you're under no obligation legally to pay more tax than what the rules actually require. Navigating those rules effectively is the name of the game.
But we absolutely have to hammer home that crucial disclaimer one last time.
Please.
Yeah.
Yes. These strategies are multi-layered, they are expensive to set up and maintain, they carry audit risks, and they require constant guidance from specialized, qualified professionals.
Do not make any major financial moves based solely on something you heard here today. Always consult your own qualified legal and tax counsel first.
Absolutely essential.
Okay, so wrapping up. If the way we pay and interact with taxes is truly moving towards this future of automation, transparency, maybe even user choice via smart contracts, as suggested by some of the thinkers in our source material, here's a final thought for you to mull over. What's the single most immediate change you would want to see in how public funds are managed and allocated in your own community?
Something to think about.
Definitely. That's it for this deep dive. We'll catch you next time.